Hello, it is FT Limited. Welcome to our deep dive into the world of Forex trading. Today, we're exploring the top 7 risk hedging strategies that can help you mitigate potential losses on Forex platforms. We're going to break down each strategy step by step so you can walk away feeling confident and ready to trade smarter. Let's start with the simplest one, direct hedging, sometimes called a perfect hedge. Think of it like this. You buy 100 shares of Apple stock, but you're worried the price might drop, so you buy a put option that gives you the right to sell those shares at a certain price, even if the market crashes. That's direct hedging in the stock market. And it works similarly in Forex. You open 2 opposite positions on the same currency pair. For example, let's say you think the euro is going to go up against the dollar, so you buy euros or go long. To hedge, you would simultaneously sell or short the same amount of euros. This way, no matter which way the market moves, you're covered. Now, let's say you want to get a little fancier. Cross-currency hedging is like diversifying your portfolio, but instead of different asset classes, you're using different but related currency pairs. Imagine you're holding euros and are worried about a market dip. Instead of directly hedging with another euro trade, you could sell British pounds. Why? Because historically, the euro and the pound tend to move in a similar direction. So if the euro falls, there's a good chance the pound will too, offsetting some of your losses. It's not a perfect hedge, but it adds an extra layer of protection. Options hedging is like buying an insurance policy on your trades. Think of it like this. You're going on a trip and you buy travel insurance just in case your flight gets cancelled. You might not need it, but if something goes wrong, you're protected. In Forex, options give you the right, but not the obligation, to buy or sell a currency at a specific price in the future. Let's say you're long on the Japanese yen. You could buy a put option which gives you the right to sell the yen at a certain price. If the yen drops, your option acts as a safety net, limiting your losses. Now let's talk about CFDs, or contracts for difference. CFDs are like the mirror image of your Forex trades. If you buy a currency in the Forex market, you can hedge that position by selling a CFD on the same currency. It's a direct hedge, but instead of opening 2 separate positions, you're using a CFD to offset potential losses. The beauty of CFDs is that they're very flexible. You can use them to hedge a portion of your trade or the entire thing. Chapter 5, Arbitrage Hedging, Exploiting Inefficiencies. This one is for the more experienced traders out there. Arbitrage hedging is like finding a $100 bill lying on the ground. It's free money, right? Well, almost. Arbitrage involves taking advantage of tiny price differences for the same asset across different markets. For example, you might find that the euro is trading slightly higher on one exchange than another. You can buy the euro on the cheaper exchange and simultaneously sell it on the more expensive one, locking in a profit. Chapter 6, Forward Contract Hedging, Locking in your rate. Forward contracts are like pre-ordering your coffee for tomorrow morning at today's price. You're locking in the exchange rate for a future date. Let's say you're a business owner and you know you'll need to exchange a large amount of currency in a few months. You can use a forward contract to guarantee today's exchange rate. Chapter 7, Hedge Funds and Algorithmic Hedging, the big leagues. Now we're getting into some really advanced stuff. Hedge funds and institutional investors often use complex algorithms and trading strategies to manage risk on a massive scale. Imagine a computer program that analyzes millions of data points every second, looking for tiny opportunities to hedge and profit. These algorithmic strategies are like the Ferraris of the hedging world, incredibly powerful but also incredibly complex. Outro, level up your trading. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insights into Forex trading.